Markets continue to reach all-time highs. Well, is this a good time to take profits? We'll be talking to Ted Oakley. He is returning to the show, and he is a founder and partner of Oxbow Advisors. Ted, welcome back to Kitco.
Thanks, David. Good to see you again.
We spoke a couple months ago, and one of the core messages that you gave to the audience was that the Federal Reserve was responsible for a lot of the gains that we've experienced in the stock market over the last year or so. We'll be addressing this again. But I wanted to ask you more simply. A lot of market practitioners, investors, I've spoken to economists alike, they've all anticipated a market crash sometime in the foreseeable future. In fact, they've been saying this. Some people have been saying this to me since last summer. Why hasn't a crash happened yet?
Well, David, what happens is, we look at a lot of sort of quartiles in the market, sort of where we are. And the market was probably, even 2 or 3 years ago, was in the 80% quartile. Now it's probably in the 95% quartile, which doesn't mean it has to break tomorrow. It just means that if you know numbers, you're at a point where things are very expensive. And I would say what would happen is when you're going to see that probably is one of two ways. Either we go into somewhat of a slowdown after this initial burst off of the low of COVID, or you go into a situation where inflation comes back and they weren't ready for it. I'd say one of those two things could probably have some impact. But for us, and we do a lot of research, have a lot of material going way back. We just know we're in the last innings. We just don't know if it's the 8th or the 9th.
Well, yeah, or maybe we can go overtime. Who knows?
Could be.
Do you think there is a risk of a double dip recession, Ted? I'm looking at indicators such as the yield curve. The yield curve has been flattening over the last 3 months.
I'm thinking what's going on now with the interest rate situation is that obviously, you've got the Fed in buying on the short end, and you've got the long end basically saying that, hey, I don't know about this if it's going to work that well. And so you've had that happening on the short, this is a 3 to 5 month phenomenon, because with the passing of this new bill that's coming up here soon and all the money that's coming back out, we run a fairly high risk, David, I think, of having that reverse. In other words, having people get caught with all this low yielding or no yielding paper, and then all of a sudden that inflation that they think is going away stays up at 4 or 5%.
Yes.
And when that does, the bond market eventually will say, hey, we've got it wrong. And I think that's where we are right now.
Okay. Which new bill are you referring to?
Well, in the infrastructure bill that's there, they look like they have enough people to push it through. There seems to be, again, a lot of money in there that is probably going to other things besides infrastructure.
Biden has said that the infrastructure bill, spending on the infrastructure bill, would actually decrease inflation. It's supposed to help with inflationary pressures. Do you agree with that statement?
Not at all. I don't think you bring a bill of that size at a time when your economy is on fire and everything is supply demand is out of line and that sort of thing. I'm not certain where he gets that, but we wouldn't agree with that.
Well, generally speaking, is inflation a concern for you?
It is more so than most people probably. We think this idea that you're going back to 2% inflation just will not work over the foreseeable future. I mean, we're not looking for runaway inflation like we had. I was around in runaway inflation, and we're looking for something that stays in that level up at 4 or 5%, and it's hard to pull off of that once you get it in place. And I think that's what is going to throw people off here.
Okay. Now, again, broad range of viewpoints from different investors I've spoken to. Some people agree with you. Some people would say that inflation is transitory. If you break down the CPI index, if you look at the components of things that have spiked up the most in price, shall we say, used cars, trucks, some would argue those components are transitory in nature. How likely is it that, for example, used cars can stay elevated in price, especially once supply issues are fixed? So if those components mean revert, could we expect then the overall aggregate CPI to also mean revert downward? Is that possible, Ted?
Well, it's certainly possible, David. I think what they leave out on that is that your rent moratorium just came off. And so rents they're a 6-month lag. And so they're not in the numbers really. We have 1 month in the numbers. So if you look at the next 5 to 6 months, that's probably going to be another 1.5% itself. So you could have these other things you're speaking about fall back and still have an inflation rate that stays higher because we're not factoring in real estate. I'm talking about rent now. That's a big part. That is yet to come. And so we'll see, but I think it'd be hard to get back to 2.
Right. Well, are you concerned about the economy? Are you concerned about people not being able to afford rent like they were last summer? That was a concern last year. Are you concerned about people not being able to find work anymore? Are you concerned about another run of lockdowns? These are all concerns that people had last year. Are these concerns still prevalent to you as an investor today?
I think the biggest thing that's the concern to us probably is that you'll have a falling dollar eventually.
Okay.
Because you're going to, and that will really impact the average person, not the person who owns a lot of stocks and bonds necessarily, but it would affect them as well. But that falling dollar would create inflation in its own. And I think people are not really ready for that. But when you're creating as much debt as we're creating, you're in a position to where when you start trying to take that away from the table, you're going to have a problem. And that's where we see the big problem.
Speaking of creating debt, last time you were on the show, you mentioned that, and I quote, if you look at the last 10 years, it's all had to do with the Federal Reserve. What were you referring to exactly?
Well, what's happened is if you look at where rates came from in the last 10 years and really the last 11 years, but if you look at what's happened, they kept rates artificially low. And when you keep rates artificially low, you encourage more debt than you should normally have. And that's just grown on itself. And so as that's grown on itself, it's inflated the asset prices. So people were encouraged to borrow more, and then they weren't afraid to borrow more. And that's where we are today. They're not afraid to borrow. And the asset price inflation, not just stocks and bonds, but real estate as well, and private business. And that's what the Fed has encouraged. And I think what people don't realize, you're talking about income inequality, is when you do that, you're creating a lot of money for people that have things, have stocks, bonds, real estate, and the people that don't have. So it just exacerbates that all the time. And I think that's what the Federal Reserve has done. We really don't let them off the hook on that.
So let me just go back to my introduction then. If we assume that what they're doing now, the policies are unsustainable, and if one were to assume that eventually they would have to normalize rates down the line, why would I wait for that to happen as an investor? Why wouldn't I take profits today?
Yeah. I've mentioned to a lot of people, David, that people ask me, how are we going to pay off the debt? And I always say to them, hey, we're not going to pay off the debt. We have too much. And we're knocking on 30 trillion right now, just government debt. And the problem with that, I'll give you an example. The Fed's still buying 40 billion of mortgage backs a month. And here we have, a super hot residential real estate market. There's no need to do that at all. And they're still doing that. They bought every bond the Treasury's issued, every bond and more, since March of 2020. You stop and think about that. The Treasury's issuing, they're buying, the money's going back in the economy. And so our biggest problem with all of that is that you're going to get in a position to where eventually they can't raise rates much because, you're in a position where there's too much debt. Now, let me say this. The problem they will have is if they get into a position where all of a sudden you do get 4 or 5% inflation sustaining, then they're going to have to really be they're between a rock and a hard place then.
You mentioned to me offline some investors you've spoken to are experiencing what you may call liquidity events. They're selling their portfolio, they're selling the homes and whatnot. If I were one of these people, Ted, and I came to you and I said, look, Ted, I would like to sell my holdings, maybe reinvest some of my earnings. Where could I go right now? We're in a low yield environment. Interest rates are low. The investors are looking for yield where maybe yield is hard to find. Where would I go? And we'll get into your specific investment strategies.
Well, what happens, and I think you know from before that we work with a lot of people that sold companies or really gone public or something that have a lot of big liquidity event. what happens now is that when they have that money, so you walk in today with fresh money, and we get fresh money every month, but when you walk in and you look at that and you think, okay, where everything is really low. I'm talking about it from a yield standpoint. If you want to stay conservative, if you want to stay in a completely non-volatile situation, then those yields are really low. And what we've had to do is really move into some things, for example, like too big to fail bank preferreds that are paying nicely. You're talking about 5% on average or higher. You're seeing us into the medical real estate investment trust area. We own energy, we own foreign, and then we own a number of commodity type things where they do pay high cash flows. So you have to adjust into the areas where the cash flow is really coming.
Mm-hmm.
And that's what we do.
Okay. You have three strategies, you told me: conservative income, aggressive income, and stocks. Let's start with the stock side. Well, actually, before that, first of all, last time you were on the show, you said that on the aggregate, you're about 35% in cash. Have you changed that cash position since 3 months ago?
Not, David, not a lot. We're probably on average about 30% now, and that's because we've picked up more, somewhat more in the higher income area, but generally it's about 30.
Okay, and let's talk about the stocks now. Stocks are roughly 25%, 20 to 25% of your portfolio. What are the
Right. Our stocks probably have 23, 24% liquidity in those stock accounts.
What sectors do you like now?
Right now, and you have to, it's interesting. We don't like financials at all. But we have, pharma is still cheap. If you look for us, for example, we still own J&J and Merck, Novartis.
Mm-hmm.
We like pharma at this point. We still like the high cash flow, no debt, growers and companies like the Alphabet and Facebook and Amazon. I know a lot of people own those, but those are large companies, but they still really produce a lot in terms of putting it on the bottom line. Now, not to say they'll do it forever, but they are right now. And so we have a mix of that type of thing. And we look at, we like healthcare, and that's but we underweight banks right now, but we overweight the other areas.
Okay. All right. Excellent. And you've got two income strategies. So conservative and aggressive. What's the difference, Ted?
Well, conservative is very, very non-volatile. We actually, up until this past 18 months, we didn't own anything with more than a 48 to 60 month maturity. And we don't own bond funds. Our problem with bond funds, David, has always been that when rates go really low and people put more and more money into a bond fund, it dilutes the bonds you bought, say, 4 years ago or 5 years ago at a really nice coupon in a fund. We own direct bonds. And so for us, we have the ability to do that. But in that conservative strategy, the only thing we've changed in it, it's still a very conservative strategy, we never had a down year in it because it's so short term. Mm-hmm. But what's happened is we've had to revert to about 15% of that account in the too big to fail banks preferreds, because that's the only way we could get the yield up to about 1.4 or so, 1.3, 1.4. You have to make some adjustment. If you look at CDs, treasuries, munis, 60 months and less, they're not paying anything. Not the quality anyway.
Right. So you're not concerned about the duration of these bonds. You're not concerned about, well, you mentioned earlier, interest rates wouldn't rise too much. So you're not concerned about the bond market taking a hit sometime down the line?
Oh, we are. I think that's why, because we own some legacy bonds that are up prior to 3 years ago. We had 10 to 20% of the account that was a little bit longer term. We still own those legacy bonds. We're not going to sell those. But here's the thing, and people, I've been through this recessionary thing before. I mean, I'm this inflation thing before. I'm old enough to have done that. And when I first was in the business, you couldn't buy a bond that didn't go down in price over the next 90 days because you were inflating. And so, but the key to managing through inflation with a bond portfolio is you have to have bonds that are repricing all the time. If you go into an inflationary period and rates are going up, you have to have bonds that will reprice every 3 months or so. And that keeps you on the curve. What people do, though, a lot with bond funds and that kind of thing, David, is they'll go out and buy a 20, 25-year bond fund. Well, you have no protection then against rates going up.
Yes.
Because every bond's long-term.
Yes. Right. But just on that note, you mentioned that should inflation go up, interest rates should follow. I've seen the reverse in the last 3 months. The 10-year has been falling, yet we've got 3 consecutive months of inflation higher than the Fed's 2% target. Why is that?
I think it's because they believe the Fed. I think they believe this area. They've saved them before, and they think they'll save them again. Now, we're not big Fed believers, and the last Fed person I may have mentioned to you that I believe was Paul Volcker.
Yeah.
But so outside of that, I'm a cynic when it comes to the Fed. I think it's a lot of academics that really don't necessarily understand what's happening in Main Street. But having said that, I think that what's going on in the financial markets is they believe that. And so they're buying that. But if somebody walks into me and tells me, hey, I want to buy that 10-year treasury for 1.2 when we're inflating at even 2 or 3,
right,
you're losing money, automatic losing money. So that's where we come from on that. I think that people are buying them, sort of drinking the Kool-Aid, but we don't agree with it.
So you think the bond market's slightly overpriced. What about the commodity side, Ted? What about the gold market? Gold hasn't done spectacularly either over the last 3 months, despite higher inflation.
That is true, Dave. You know what's happened is it's bumped up here. It got up to around 1840, and then it's had a little profit taking really the last few days. I think what you'll see is once gold goes into the high 1800s, that people will realize that, you know what, and normally what's been happening is gold and the bonds have gone together. So if the bonds were doing well, gold would do well. I think that decouples, though. I think for the first time in a long time, when you get into the next 3 or 4 or 5 months, you're going to see a situation where the bonds go the other way, they decline in price, and gold picks it up and it goes the other way. And so I think the good part of gold is going forward because it'll have a lot to do with the dollar. Okay.
So you think gold's going to pick up? That's the part that's going to catch up, you think?
We do.
Okay.
We think so.
All right. Do you have, let's say, a price target in mind or not?
Well, not necessarily. We really don't have a target in mind because we want a own goal for obviously the next 5 years or so.
Okay.
And I think for us, we are particular about this now. When we buy the miners too.
Yes.
And we like the miners where they have royalties as opposed to buying the direct miners themselves. Mm-hmm. So like we own Royal Gold and that type of thing, Franco-Nevada. Mm-hmm. Those really, let's say gold goes from 18 and a quarter to 1825 to, let's just say it goes to 4,000 or 3,000. Those companies that have the royalty overrides will really, really do well because they're not having to plow money back into capital equipment.
What if I told you there are some emerging cryptocurrency funds that invest in, well, what they do is they'll take, let's say, Bitcoin or Ethereum, some of the larger coins, and they'll place it in a custodian, and that custodian would pay off double-digit interest rates, I've heard. APR in 15, 20% even. Would you consider buying a piece of that fund as a fixed income derivative or a substitute?
Not in this lifetime.
Why not?
No, because first of all, I think that the whole crypto market, I think there'll be some cryptos that really survive probably. But in general, I think it's a market that will go down as one of the golden, as they say, golden frauds of this decade, actually, before it's all over with. Because I think people will eventually look up and say, you know what do I really have here? And I think that's the way it ends. Now, you look at somebody that custodies that, and you look at everything going on with, Bitfinance and Tether and et cetera. I know there's a lot of things coming down in this area, but it's, I think for the average investor, they don't have a clue. That's a personal opinion, but that's what I think.
Well, okay. Well, you said they'll reflect on what they have. What do you think they have right now? How would you describe the asset class?
I think the class itself, you know, if you look at it, you've got what, 4,100 cryptos?
Thousands, yes.
Now, yeah. And so if you look at that many cryptocurrencies, obviously the people that are buying those don't know how that's going to work out. And I noticed just this week where Gensler, the SEC chairman, just came out and said, hey, we're getting ready to crack down on cryptos. We're going to take a look at the regulation of how they're held and what goes on. You know, you've had a couple of countries overseas. So what I'm thinking is you will end up with some cryptocurrencies that work. But I would say by and large, though, if you're back in 1995 or 96, you had an unbelievable amount of internet companies.
Sure.
I mean, every kind you can think of. Most of them went away.
Sure.
And they were right on this count. The internet really did become something. I think crypto will really become something. It's just that I think what happens is you will drain off all of these things that really don't mean anything. Right. And you'll get back to true cryptocurrencies that will really work. And the blockchain is obviously where it's really all going.
Just on that note on regulation, does the SEC have jurisdiction abroad? Let's say a cryptocurrency was operating in, you know, somewhere in Eastern Europe or China or someplace. What can Gary Gensler do?
That's a good question, David. That's out of my league, so to speak. I know a lot about what they can do with investment companies in the U.S. Yeah. But if somebody's operating, the only thing I would think is if you're using it in the U.S. as a user, and they think they can protect you, maybe. But I honestly can't answer that. Really.
All right. Well, I suppose it's for individual investors who may be misusing the investment to their own advantage, pumping and dumping, so to speak. They're U.S. investors. I think maybe regulators can crack down on that. John McAfee was an example. All right. Well, Ted, I appreciate your insights. Excellent update on the markets as usual. I look forward to speaking with you again. Thank you.
David, thank you.